Having a high credit score gives you so many options. You can get the credit cards with the highest rewards, and you can get the absolute lowest rates on any loans you use. If you apply for a mortgage without an exceptional credit score, you're leaving so much money on the table. It can even increase your chances of getting a job or getting into a nice rental, since employers and landlords often check it. It's the financial industry's best estimate of how responsible you are, and it can carry over to other realms outside of just finance. I've had an 800+ credit score since I was 22, and manage the corporate credit line of an engineering facility, which requires me to maintain very high credit. My current FICO score is actually perfect at 850. This article gives an overview of how to improve your credit score fast and reliably, including the 4 biggest impact tips you can implement this week. How FICO credit scores are calculated. Here is the breakdown of how a credit score is calculated by MyFICO. There are several different ways to calculate a credit score and a bunch of companies that do it a bit differently, and each method has various pros and cons. Each method also has a range, with the main ones having a 300 to 850 range. The chart above shows the default way that the general FICO score is calculated by the FICO company. Generally speaking, having over 750 puts you in the very top bracket, where you'll get access to the best credit cards and the best loan terms, and will have no problems when employers or landlords check your credit. If you can go further, T0800+, then you're comfortably in the top tier and roughly at the maximum end of the range. 35% payment history. This is the single biggest factor: how reliably you pay your bills. By never, ever missing a payment over the course of years, your credit score will start to climb. This can actually be kind of forgiving. Even if a payment is a few days late by mistake, most companies have a grace period where they won't report you to the credit agencies. You generally have to be quite late in order for it to officially become a late payment. It's best not to take chances though. Pay all your bills every month like clockwork. Automate your payments if it helps you. I personally like to sit down in the 3rd week of each month and check every one of my accounts to pay them and keep everything tidy. It takes about 10 minutes. 30% amounts owed, credit utilization. Creditors like to see that you're not using anywhere near the maximum amount of credit available to you. If you have 2 credit cards, each with a $5,000 limit, and each of them is filled to $4,900, then it looks to them like you're being irresponsible. Just like how some people's expenses reliably expand to equal their income, this example looks like someone who naturally tends to borrow as much money as they can. That makes them look risky. Instead, it's best to have very high credit limits, and then use only a small fraction of them. A rule of thumb is to use less than 10% of your total credit limit, and to not use more than 10% of any individual credit account. You can optimize this by adjusting both variables. You can spend less, and you can open new credit accounts or ask for increases on your existing credit limits in order to minimize your credit utilization ratio each month. You can also spread your purchases across multiple cards so that you never use a large portion of any card at once. 15% length of credit history. If someone opened their first credit account 6 months ago and has paid 100% of their bills on time, that looks pretty good. It's a nice start. But it doesn't look anywhere near as good as someone who has had several credit cards for 10+ years, who has never missed a payment on any of them, and has never missed student loan, mortgage, auto loan, or utility bills. Some of this obviously just has to come with time, but your actions can influence it as well. Suppose in one example, you open up your first credit card account today, and open up another credit card account 5 years from now. 10 years from now, one of your accounts will be 10 years old, and the other will be 5 years old, so the average age of your credit history will be 7.5 years. Now, suppose that you open up a card account today, and then open up a new card account every 2 years. At the 10-year mark, you'll have 6 credit accounts that are 0, 2, 4, 6, 8, and 10 years old. The average age will only be 5 years. It's generally better to have fewer, older accounts, rather than having a clutter of many newer accounts. Also, it's almost never a good idea to close an old account. Those old accounts are your anchors that you should try to keep forever, because they dramatically increase your overall length of credit history. 10% credit mix. There are 2 main types of credit: revolving credit and installment credit. Ideally, you want at least one of each, because it shows creditors that you can handle multiple types of loans. Credit cards are the main type of revolving credit. If you have at least one credit card, then you have some revolving credit. It's revolving because there is no end date. You can just tap into it as much or little as you want each month, and pay it off regularly. Student loans, auto loans, and mortgages are examples of installment credit. They have a natural end date, and they expect regular payments each month of the same amount. I have a coworker with a high credit score that got rejected for an auto loan. The credit score is important, but it's not the only factor lenders look at. In her case, her parents paid her way through college, so she never had student loans, and didn't yet have any sort of mortgage or auto loan. All she had in her credit history was good credit card usage. The lender was not confident enough to give her a big auto loan despite the fact that she handled her credit cards well, because there just wasn't enough information there for them to feel comfortable. 10% new credit. If you open up a bunch of new cards or loans at once, it looks risky. Lenders will wonder if maybe you lost your job, and you need to stay afloat with credit in the meantime. Or maybe you had a big medical bill and are becoming insolvent. Be conservative with the number of times you apply for new credit.